So now what we're going to do is have a panel here. We've got 3 esteemed guests who I'll introduce in a few minutes. What we're going to do is I'm going to take them through a bunch of questions, and then I'm going to open it up sooner than I normally would with a panel, because I think a lot of people here will want to have unique questions I probably haven't thought of. So maybe I'll start with Nikolai. Ready? Nikolai, I think. So first of all, I have a intros here, and I never stick to what I actually write. So Nikolai should be used to this. Look, Nikolai is someone that actually makes this ecosystem work. He has ambitions to build a global unicorn or one of these big companies. He's based here, but will go wherever he needs to build a company. He's had 3 successful companies before, and he basically makes sure that he needs to get done what he needs to get done. He gets, yeah. But I think more importantly, and you'll see Nikolai is also a quantified self-junkie who is often seen sporting multiple wearable devices. And I think just before this event had a drip of some sort to make sure he's healthy. Sorry to embarrass you, Nikolai. Nikolai got 2 of his board members to come join us. I don't know how he convinced them to come up to Toronto in February. I think was this your first board meeting in Toronto in a while?
Yeah, we used to do our board meetings.
You have to turn it on, I think. Yeah. Turn it on. Sorry.
Hello? Yeah, we used to do our board meetings in San Francisco, and then we started doing more board meetings in New York, so we thought, why don't we do it in Toronto? So here we go.
Yeah. So up from New York is John Frankel. He's from FFVC. John is a founding partner of FF Venture Capital and has been a seed and early stage investor since late 1999. He has served on the boards of more than 35 companies and has led investments in more than 80 companies, including Indiegogo and 500px, which is a local company or was a local company. Not sure anymore. It's owned by China now. Prior to founding FFVC, John was at Goldman Sachs for 21 years in a variety of roles. John started his business career in London, and I think you'll hear that when he speaks. Finally, and not least, is Kimmy Scotti of 8VC. Kimmy is a founding partner of 8VC, where she focuses on consumer and healthcare investments. She also is a co-founder and executive chairman of the women's health and wellness company Monthly Gift. Prior to that, she was at a family office, and she seems to be entrepreneurial since high school, where she founded a fashion jewelry line that was sold in Bloomingdale's and featured on the hit television show Project Runway. So I guess you've been doing consumer since you could start. Yeah, cool. So can I hear a good round of applause for the panelists? So I'm going to start off with some softball questions. Nikolai, can you explain to us what OpenCare does and maybe give us some idea of the scale of the business or where you're at? I know you're quite secretive about it, but I think it would help to give some context of where you're coming from.
Well, I guess I'd say we're not really secretive, but rather we don't like beating ourselves in the chest, and we don't really spend much time on media and PR, which probably we should. So I guess about OpenCare, so in a nutshell, what we're today, and maybe I'll start with the size, and we're 40 people. Some of our team is in the back there in great OpenCare hoodies. We've raised quite a bit of capital, which we don't really talk about. We raised just over $35 million Canadian, and we've been, thank you. We've been delivering a lot of value through our marketplace to the dentist. Right now we're focused on dentistry, so we deliver around $165 million in patient value to our dentists on an annual basis. So it's a very growing marketplace. In a nutshell, what we do, we connect patients with high quality vetted dentists. That's what we're on the surface, but if we really unpack where we're coming from, it's actually this company came from really deep drive from my co-founder and myself of trying to make people better versions of themselves, and we believe health, either it's physical or mental health, is a really fundamental element of anybody to live fulfilled lives and happy lives. And we started with dentistry, and the reason dentistry was interesting to us. it has a lot of interesting dynamic. It's a doctor that we see the most in our lifetimes. If we're a good patient, we got to start seeing them when we're 1, and we got to see them twice a year. It's a massive industry, $129 billion spent in US on dental services, $15 billion in Canada. And let's be fucking honest here, everybody hates going to a dentist. So we thought if we can make people go to a dentist, we can make people do a lot of other great things for their health. And what's interesting, we've actually made big strides in that. Whoever's familiar with Net Promoter Score, we've been getting a Net Promoter Score higher than iPhone and Netflix. So now our in-house joke that we finally made people love their dentists more than their iPhones and Netflix. Of course, we've started with really low bar. What we're doing really on a dentist side, what we realized to deliver a great experience for the patients that we send to our dentists are actually missing a lot of tools. They're doctors, and they've been taught for 10 years how to deliver care, not how to deliver patient experience. So we're actually building an operating system that will run all of the dental practices, so dentists can just show up, do their work, treating their patients and delivering care, and they can go back home, and the money magically lands in their bank account. So that's kind of us in a nutshell.
Well, thanks for explaining. Now I'm going to go to Kimmy and John to explain where they come from. So can you explain, either one of you can start, but can you explain where your firm, what your firm focuses on, the thesis, and sort of where you operate as a VC?
So we're technology investors, and we're seed stage. So our modal first check is $400,000 to $700,000 for 10% of a company. We tend to start pre-revenue or early in the life of a company before the technology risk and the product market fit risk has really been sorted out. And then we follow on through until an early B, about a 50 million valuation. We've been doing it a little over a decade. We have 70 portfolio companies, of which 20 of them are now worth over 50 million US. And I think we now have 14 over 100 million, with aggregate market cap of around about 4.5 billion. We've exited at around about 2.5 billion. So in aggregate, about 7 billion of market cap has come about from companies that we often led their seed round in. Within tech, we like AI and applied AI at the moment. Applied AI for us, drones, robotics, fintech, cybersecurity. And we're very engaged investors. We tend to lead rounds, sit on boards, and work to help our companies succeed. And there's a stat out there which is, kind of annoyingly stark, but it's a reality that 90% of seed-funded companies, and not every company gets a seed round, but 90% of seed-funded companies don't get to a Series B. A very few lucky ones get acquired before the B, but most of them just don't make it. We've got 10 years of data, and it's about 50% of our companies get to a Series B. So we're beginning to see some proof in our approach.
Cool.
Hi, I'm Kimmy Scotti. Our fund is called...
Hold it up.
Oh, can you hear it?
Yeah, that's better.
Yeah? Hi. Our fund's called 8VC. We're San Francisco based, but I spend my time between New York and SF. We invest everywhere, though I think this is our only Canadian company right now.
No, I think
We have a couple of other
From
small,
the previous fund.
from the previous fund, exactly. But this is my only one in Toronto, thank God. Kidding.
Hey, in summer it's pretty nice here.
Yeah. So the next board meeting will be in summer. Our sweet spot is really A's and B's, though we led Nikolai's seed and A. So we certainly do seed all the way up through early growth. We're about $3 billion under management. This fund is about 680. So it's a pretty large fund or a pretty big team. We spend most of our time in two areas: smart enterprise, which we define as vertical enterprise software for those industries that power society. So think healthcare, finance, GovTech, things like that. And then to some extent, I guess, energy and education, though we don't do a ton in those spaces. And then the other chunk is really bio-IT, kind of the convergence of biology and computer science. And so really interesting spaces. 20% of what we do is totally random, opportunistic things. And a lot of our consumer portfolio sits there. I spend a lot of my time in the overlap between consumer and healthcare. And so that's what we're doing here. And so anyway, I'm so excited to be here.
Cool. Now that we know what your firms do, maybe explain, because I think with lots of founders in the room, explain how you guys look at a potential investment opportunity, what the process is, just from when the opportunity hits your desk, or I guess your inbox, to actually making an investment. Can you give a quick overview of what steps it takes and what you need to do to get an investment? Your guys are too polite.
So I like them. They're like almost Canadians.
Yeah. So I think one of the things that we are always looking for is people who are resourceful enough to get introduced, right? We want to be introduced to you by someone we know that tells us this person's smart, and with just a little bit of courage and asking around a little bit, you can usually figure out a way to get an introduction. That said, if you can't, send the cold email. This is what we do all day, and you're never bothering an investor, right? This is our job, is to look for companies, look for like the next big thing all day long, and so we're so excited to see an inbox full of new ideas and excited people. Our process is fast. It's part of what we do is try to get people through the process as quickly as we can because the best deals are the most competitive, and so speed becomes very important. We try from introduction to sort of the first meeting to make it less than a week, especially on the seed side, because you ideally have lots of people who are interested in what you're doing, and we want to be first. We want to see it first. After a first meeting, usually with a partner, sometimes with one of our team members. Like, we have a fantastic stack of associates and principals who are super geniuses. I feel like we have no right to how smart our team is. We will talk about you in our partner meeting on our next Monday's meeting. And so it happens very quickly. Come back to you with a lot of questions and ask for access to data. One thing I would say is never be afraid to share that information at that point. Most VCs will tell you, we won't sign an NDA. That's, it's kind of a thing that we try to avoid because we see a lot of things, and we'd be caged into a pretty tight cage otherwise. But we're governed by the public, so if we shared your information and you found out about it, I'm sure you'd take to Twitter and LinkedIn and everywhere else to tell everybody about it. So we're very careful. And then once you get back to us with questions, we basically make a decision, especially if it's on the seed side and there's not a lot to assess. We spend a lot of time modeling and remodeling your business, even if you've already done it, to see if there's ways we think we can help you beyond what you've imagined for yourself. And then you should do your homework on us. You should ask to talk to founders that we work with, ask to talk to Nikolai, and how do we help him, and how do we help their company, and figure out if we're the right investors for you as well. And then we basically push to a decision at that point, and then you'd get a term sheet and decide whether or not that was the right deal for you. And so that's basically the process. It's probably very similar.
Yeah, I mean, the process is very similar. Mm-hmm. One of the things we actually do, we make sure every investment professional reviews every deck every week. And so, I just hate the email like, well, let's meet for coffee first, and if it's good, I'll send you a deck. I'm like, that's not going to happen. You have to think of VCs as having the attention span of a 4-year-old. No comment. So just paint the day, right? I've got 70 portfolio companies. Now, there's 3 partners in my firm, but I know all of the founders, down the teams, and some of them very deeply, down the teams, and some of them less deeply. A ton of board meetings I attend, right? I do events like this. I look at 2,500 decks. I actually have to go and raise money now and then. So I talk to LPs. We have existing LPs, a couple hundred, who every now and then actually want to talk to the person who's managing their life savings. We have prospective LPs. There's a lot going on. We talk, Last week, I was sitting down on the same day with Goldman Sachs and Bessemer, walking through our portfolio for Series B, C, and D rounds across our portfolio companies, because we're like a feeder fund to them. So understand, the more qualified it comes in, the more you've had a look. I mean, don't send us something that's competitive to our portfolio. It's not good for you. Once we work it out, we're just going to kill the process anyway. So don't do that. Look at what we do. If it's a blockchain idea, we're not ready yet. We need some fundamental invention in blockchain before we're going to invest there. Right? So just get a sense. And you can do the same with every VC. So do a little homework, target. A warm intro, historically, we try not to bias warm and cold intros, but when I look at where we've invested, it's predominantly warm intros. So, trying to knock the bias out, it's still the bias. And I think that warm intro, there's a filter there already of people we've worked with. Something else you should know. If you get to the point that you get to a term sheet, you get to the point where an investor wants to give you money, do some more homework. Go out and reference them. Understand where you sit in that fund's life cycle, how much capital they have behind, what they do. Are they good players when things go south? Or do they, like most VCs, have the attention span of a 4-year-old and say that's in the 90% of my portfolio, it's not going to perform, not in the 10%, and so their phone rings off the hook. Time's up. Just reference the people you take money from. I saw on Twitter today, and let's see if I can paraphrase it right. This person said, like, trying to optimize fundraising for the highest valuation is equivalent to trying to employ a key executive in your business at the lowest salary possible. You're probably optimizing for the wrong thing. So optimize for the people, what they can do. Most companies fail. There are some people out there who are talented and some people who are lucky who can help you on your journey.
So I'm going to open this to Nikolai in a minute, but before I do, I just want one follow-up question for some details. When you guys do offer a term sheet, what do you need out of the company? Like, is there ownership percentage? Is it one partner has to sponsor the company? So get a bit more nitty-gritty in how when you come to a term sheet, what should a founder expect to make it viable for you guys?
Sure. It really depends on what stage you're at. Depending on, if you're early on, if you're an angel or seed round, the firm probably doesn't have an ownership hurdle the way that they might at a Series A or a Series B. It's more likely that it's a party round and there's a lot of people participating, or they'll bring other people in to participate with them. That also can help you. So what you're looking for at that stage is, what can these people do to help me? And is the partner, at all stages actually, you're looking for, is this partner the right partner for me within the firm? So it's not just being with a firm that you're excited about. You have to make sure that your sponsor within that firm, the partner, is the right partner for you. There's 5 of us, all investing partners, and we all have different skill sets. And so each partner has, a toolkit, and we leverage each other for all different things. But the one who you're spending most of your time with should be the one best matched to your needs. And it's very easy to see what that particular partner has done, what their experience is. And so do your homework on the person that you're going to be working with. And I think that probably does it. Yeah. Anything else?
Oh, I mean, the one other thing is make sure you know other partners at the firm as well.
Yeah.
If that partner happens to leave, if that partner's going to retire, if whatever happens and you have no connective tissue to the firm, that can be a problem.
Mm-hmm.
Now, Nikolai, we heard from the VCs. I think you know how to run a fundraising process. So what are your secrets, and what should, as a founder that's about to raise money, do to optimize the process? What are your hacks?
Yeah, I think it's a great question. A lot of my friends have come to me asking the same question, and I would say there are 3 core things when I look at this. Number one, I think early on in our business, we were building our business for investors and for fundraising, which was the stupidest fucking thing we've ever done. And we refocused to build a business for ourselves. We wanted to build a business that had strong fundamentals and created real value. And I think the startup world still has so many companies building companies for fundraising. You want to be strategic and tactical about when you're going to go out, raise the story you're going to tell, et cetera, but ultimately it's like focus on the fundamentals. If the fundamentals are there and the business is real, that's basically a huge chunk of the fundraising, like build the real business. Number two, I'd say, even experienced founders, I look at that, like get really prepared for fundraising. The best fundraisings I've done was like, I've spent a lot of time preparing, and anybody who asks me, I tell them, you gotta spend at least 3 months preparing. So going into the last fundraise Kimmy and 8VC led our seed, and then they led our Series A back in March, and it was a really large Series A. Before that, I spent 3 months preparing. Before I walked into any meeting with any partner with a new fund, I had at least 5 different reference checks on that partner. I almost knew like the type of coffee he has for or she has for in the morning for breakfast. And I knew a bunch of like internal fund politics. I knew where their strengths are and et cetera. And it required a lot of work. But having this, I felt like I had superpowers because I knew how to navigate each fund and I knew who is the right partner to talk to. Besides that, when it comes to preparation, not only do the homework, as was kind of shared here, do the homework on the story you're gonna tell, and that kind of leads into the third point. I think your comment about the attention span, it's 100% true. One of my friends who is a VC said that the hardest part of his job is not to fall asleep. There are a lot of horrible pitches. They're just like, I've sat through some of them, I was like, holy fuck, how do you do it every day? Like, I would shoot myself. And so you gotta be really able to communicate the dream you're trying to build. If you get lost in the numbers and the details and the industry jargon, like, I've checked out, right? Like, I don't understand what you're talking about, and it might be the best business ever, but storytelling is so critical, and I'll tell you what I've done on my end. So luckily, I feel like I could walk into some rooms and energize the rooms, but I realized I was still using a crutch when I was like pitching investors because I was just using my energy and excitement to get people excited. But then I took a bunch of courses and workshops on storytelling. I went to LA and spent a day in a workshop with a guy who teaches directors and playwrights in LA. His students, for example, did Breaking Bad. And he teaches you how to develop a story. There is science to story. Everything can be learned. So there is a story to a deck. If you cannot communicate your business in a story, one thing he actually said that really stuck with me, our human brains are story-making and story-consuming devices. So we only understand each other in stories, and if somebody starts spewing science or data or whatever, we're taught to argue that and question that and et cetera. So create a story. So really those 3 points, have a real business, really, spend time preparing and invest in like creating a story that it's easy to understand. And last point on that third point, the test that I do, I ask myself, will my mother understand what I'm saying? And I literally standing in front of the mirror and pretending I'm talking to my mother, and I was like, we're in dentistry, and then I start talking about dental support organizations and private equity guys rolling up all the clinics and et cetera, and I was like, holy shit, I just lost her. So we gotta pull this back and really explain it in the 3-year-old terms.
If you come away with anything tonight, that is the most powerful thing. I will tell you, I think maybe 15%, I'm being generous, of founders I've ever spoken to could explain in a single sentence what they do. That's ridiculous.
I'm still struggling with that.
I know, but you need the single sentence. And you need the 12 to 15 page deck, which is the story arc. Yeah. Your ability to communicate is not only important for investors, it's for team. The the team that OpenCare is going to hire, and if you haven't cottoned on today, they're hiring for anyone who's looking for a job in a great company. It's going to be a unicorn in US dollars. Where was I? So, yeah, no, I think I lost my words. So, but it is so important to be able to tell the story. When employees come on, they're so excited, and they think they know what the company is. They have no clue. And if you can't articulate and get everyone on the same page, and this is our mission, these are our objectives, that's what we're doing in the next 3, 6, 12 months, they'll go off and do the wrong stuff, and you won't run as an efficient organization. Storytelling, essential.
Okay. I'm going to switch it up a bit now. We're getting great answers, but I do want to open it up to the crowd. I'm going to ask 3 questions. Let's try to, give me your random thoughts or quick thoughts. Toronto, is it an interesting place to invest? Yes or no, and why? Other than OpenCare. Are you actively looking here? Like I see you guys have. You guys have companies like I see 8 VCs in Neighborly, Wish, and OpenCare.
Yeah.
So they're all Toronto Waterloo originally. So what do you think about the area?
Yeah, we're very excited about Toronto. First of all, it's a quick trip from New York, so it's super easy for us to get here for a board meeting, even in February. But we're really looking everywhere. We spend still probably 70% of what we're doing is in and around San Francisco and the Valley right now. But more and more of our like most exciting companies, our largest investments are all in New York right now. And we hope one day that OpenCare is one of our largest investments, and we can say they're in Toronto. You've incredible tech talent here because of the Waterloo network and people moving to here after school, and so we're very excited about what's going on here. Also, there's incredible government programs around hiring and support for that, so it makes a lot of sense to actually start a company here. Plus, if you're in consumer, this is a great test market to try things out and then launch in the States. And so one of the things we're excited about is its similarities to a lot of U.S. cities for that sort of use case. And so, yeah. We're looking.
So John, I'll flip the question to you. What do Toronto companies do wrong, or what could this ecosystem do better? Because you have exposure to Muse, Drop, 500px.
Look, the world's flat. It's unevenly distributed. There are all these advantages that Kimmy touched on. We were in 500px that sold to Chinese investor. We're in this guy's company, whatever it's called. Dentists? I don't know. Dentist for us. .com. Yes, dentist.com. By the way, you should buy that URL. We're in Drop Loyalty. Does anyone here know what Drop Loyalty is? Yeah? Download the app. It's growing like a weed. Lots of good news coming out there. We're in Interaction, which has a Muse meditation headband. I think that's it. I got 70 companies. Tough to remember them all.
You've got a bit of exposure here. So what could Toronto as an ecosystem or Canadian companies do different, if you have an opinion on that?
It's time. You need companies to grow, to sell, create a few millionaires who want to give back to the community, do some seed investing, rinse and repeat, and you run. And New York, a decade ago, we talked about the ecosystem. It was aspirational, and it was smaller than this. Now, it's not aspirational. It's insane. We can absorb in the same week, Amazon setting up half of their headquarters, whatever that means, because I thought it was in Seattle. Anyway, half of headquarters 2, is that headquarters 4? I don't know. I can't do Amazon math. And Google doubling their space. No one even saw the headline on Google doubling the amount of space they're taking in New York. Massive ecosystem. But it's just time. This is a long boom of software digitalizing the world and taking advantage of the world being digitalized. And it's going to take another 20 plus years to completely change businesses. And it just takes time. I remember Goldman Sachs had a tech, telecom, and cable conference they called Communicopia. Because it was before this term. This was like, they came up with the term in the early 90s. No, in the late 80s. And I remember in no, it was early 90s. And I remember in 2000, Jim Cramer came to the conference and said, newspapers are ridiculous. People go into forests and cut down trees and generate pulp that gets made into special paper that goes to get printed on with carcinogenic ink to deliver yesterday's news to everybody by the morning. It's the most ridiculous way to get information, right? That was like 19 years ago, but there are still newspapers. This is a long tail of software eating the world. There's a lot of money to be lost. There's a lot of money to be made. We're moving in some industries to more centralization, other industries to more distributed models. It's an amazing time to live. It's amazing opportunities out there. And it's going to be very different in 10 or 20 years.
Nikolai, I would ask you about Toronto, but I don't want to get you in trouble. So why don't you tell us what you can expect from a VC post-investment? Is it like everyone seems to be advertising that they help you out, they'll make you a better company?
To get them to hate me?
No. So okay, well, I guess your choice: Toronto or VCs post-investment. No.
What was the question about Toronto?
No.
I'm kidding.
Yeah.
So I guess I'll be a little bit controversial on this topic. And it's one of your portfolio companies that we've been chatting with shared very interesting concept with me. Separate capital and advice, and first of all, optimize for capital, meaning that raise capital from good people, and then you can buy advice with that capital. With that said, when we went out fundraising, actually we built a criteria. It was pretty competitive round, and we had a criteria for the partner that we're looking for. And number one, you probably won't guess what was number one thing on that criteria was. It wasn't like market expertise, operator experience. It was, we were just looking for a good human being. That was literally P0, because one of the most important things is like, well, life is too short to deal with assholes, and it's already, building businesses is already very difficult. So we wanted to make sure we have a supportive partner who can then also bring all the expertise and know-how and etc. And we got lucky with Kimmy having exposure to healthcare, consumer, and etc. And on John's end, that he's like, when it comes to finance, he's like one of the best people. And they've been, poking us from different angles. So I would, in the beginning, I would optimize for specifically capital from that, really make sure they're not going to cause any trouble. There's so many dysfunctional boards with so many politics. Just watching some of my friends, it's a fucking nightmare. Like building companies, like what's Elon Musk said, chewing glass and staring into abyss. So now add a dysfunctional board on top. Your life just sucks all around. Yeah, so that's kind of my expectations.
Can I add something to that? Because I think what Nikolai's saying is actually really important. Building companies is hard. Being a founder is like a living nightmare. I've been a founder a lot of times, and you spend so much time fetal under your desk. And so if you find investors who you're kind of afraid of to tell when things are wrong, then you're under that desk by yourself. If you find good humans who you trust, whose advice you can't get enough of, and who you trust to call when you're in panic mode, which is the exact right person who you should take as an investor, is the one you want to call when you're freaking out, then you're not under that desk alone. Then you're under that desk as a team, and with their experience, with our experience, they help you figure this out. And so find people you want to work with and whose advice you can't get enough of. And if that comes with capital, great. I think that's really the most important thing about building a board out, building this kind of relationship out.
Cool. I have like 20 more questions, but I want to open up to the audience. So one ground rule: do not pitch your business They're not going to make an investment decision right now. So I'll walk around and I'll just start with the easiest one right here.
Sweet, thanks. Any one of you or all of you could kind of field this question, but I'm curious to know, like right now, if you were to think of like where we are in terms of debt cycles and economic cycles, probably like a little bit long in the tooth. And I find when I speak to a lot of people in the startup space, they're not really in tune and they don't really understand the way that could affect their business. And when you talk to a lot of startups that fail, you end up finding, well, it was like, oh, I tried to start in 2007 and then 2008 happened. And so, like, Nikolai, how much do you think about that, and did you factor into that? And then also for you, when you guys are, exercising your due diligence, like, how much is that a factor today? And I know long-term, 20 years, not so much a factor, but today, going into where we're at in terms of this short-term debt cycle especially, what are some of the things that you factor, and how does that impact businesses that you fund?
I can jump in on my end. 4 hours ago, we were sitting at our office doing our board meeting together here, and one of the working sessions was, how do we think about fundraising given where we're in an economic cycle, and what happens if there's a market downturn? And ultimately what I believe is great companies will always raise money. There's no shortage of capital for great companies. The biggest thing that we were trying to navigate is how do we not get a haircut due to us going out into the market and raising around the wrong timing. And that's really just, we have to be strategic about that, and you guys maybe can add opinion on how it affects VCs in economic downturns and et cetera.
Yeah. I mean, so understand where you're raising money from. So VCs raise commitments from LPs, and let's say they take in a $10 million commitment. They're saying, over the life of a fund, over the next 10 years, we will send you an email, a request for you to give us some of that money for us to invest. And that commitment will be drawn down over the next decade. So if there's a downturn, those commitments have already been made. Now, what happened in 2008 was a lot of LPs said to their VCs, please don't call us. Like, let our returns repair themselves a little. But outside of that, there is more money in the system now than there's ever been. And there's corporate money. And this time around, I don't think the corporates will be fair weather, because I think the AI tech stack is too disruptive for them to sit it out. Good businesses get funded. They can get funded at high valuations or low valuations, they get funded. But the most important thing that I think a CEO has to understand is they're probably not a CPA. There may be a CPA founder here, and that's fine, and we can talk about that. But the risk profiles are generally very different. And the number of founders who say, well, we're going to exit the year at a 1 million, 10 million ARR, but forget they actually have to make payroll next week, is a problem. So we really force strong accounting skills onto our CEOs, because you need to know when your numbers are going to be, your runway, your burn, etc. The other thing to understand about VCs is we tend not to invest in cyclical businesses. We're investing generally in secular businesses, and usually when the cycle turns down, cost cutting becomes important for the buyers, and the low-cost solution usually can win some market share. Now, it depends, and every company is different, and there definitely, we can have one or two cyclical companies in there. But generally, the belief is there are secular wins to your back that you're running your startup from. If you're not, you should really consider if you should take VC money.
So my name is Fahim. My question is to Nikolai. First of all, congratulations on the 35 million raise. So you did mention about storytelling, and I've gone through a whole bunch of slide decks and pitch decks, and personally, I feel like it is easier. You have your flair, you have your language and your emotion to convince them of a story. But how do you translate that on a 12-slide deck?
So my rule, and you guys will probably hate this. I never send a deck in advance. There is no way to translate it into the deck. It becomes loaded with text and people get lost and a lot of people don't even look at it. So I think it's being very tactful and nice about it. My response to anybody asking me for a deck, I respond to them, unfortunately, I don't share a deck, but I'll be more than happy to walk you through this in person. And if they don't want to do that, that means they're not even excited from the short blurb or the intro that was done. And by the way, I try to get the strongest intros possible. If somebody who built $1 billion company introducing me to a VC, and then VC is asking me for a deck after that introduction, then I think partially, I find it either they're not interested or they're a little bit disrespectful. So I just move on to the next lead. You want to add that to there or no?
The problem is you've got a conflict of process. So our process is we want every investment professional to review every deck.
But I'll send it to you after the meeting.
I understand. But there's only so many meetings if I'm running up to Toronto every now and then for a board meeting. So that's the conflict you have to navigate. And if you don't send the deck, send at least 2-3 pages, a short deck that explains the story. Because if you really can't articulate it well for people, they're not going to be able to communicate internally. And yeah, please.
So I think what's critical is really shaping the elevator pitch paragraph, so that if that's not enough to capture somebody's attention, probably they're not interested in the business, or your elevator pitch sucks. So it's really your teaser, right? If you're watching trailer for a movie, and minute into it, you're not engaged. It's like, well, it's a shitty movie. So that's exactly what happens when John is flipping through his email.
So, it's different at seed stage. So at seed stage, we don't have themes and theses. We AI and applied AI, but someone walks in with a whole new idea we hadn't even thought about, and the industry doesn't exist, and we then go and invest in Indiegogo, before crowdfunding was, a concept as such. Well, it was a concept, but it was, a theme. Where Nikolai's now at, every thoughtful Series B investor really should know about open care. They should be running screens. They've got an analyst. They're looking for growth. As much as you try not to leave breadcrumbs, you're leaving breadcrumbs out there, and the analysts are picking them up.
Around with bread and leaving breadcrumbs.
And so it's different at later stages, and it becomes much more competitive. And I think Kimmy
absolutely.
can talk.
So later stage, what Nikolai's talking about is possible. You could say, no, if I ask for a deck and you're like, I'll walk you through it, and I say no thanks, and they say fuck off, that's fair at that stage. If you are a seed stage company and you're like, no, I'll walk you through my deck, I'll come in for a meeting, and we're like, no thanks. And you're like, no, okay, fuck off. We're like, okay, fuck off, And so that's, so it's really stage specific. And so I think that's good advice where you're at. It's terrible advice for seed stage.
Got a little union form in here.
Hi, guys.
How did you do it?
What?
Did Jonathan introduce us?
Alex.
Alex. Oh,
Yeah.
yeah, partner, Alex.
Yeah.
Yeah.
So I knew one of the partners at 8VC for a couple of years.
Fair, but not necessarily the right partner for him. So he went and got the introduction to the right partners for him, and now he's on his board.
Here we go.
Hey guys, thanks so much for this candid conversation, by the way. It's really, really great. So I have an investor meeting next week on Friday. It's a half-hour call. It's not an in-person. And one of the interesting things is I get lots of different recommendations from people about how I should be preparing for that meeting. And the thing I keep getting two perspectives on is, one, I should be telling my story, because they're investing in me ultimately, versus, no, don't tell your story, focus on the business, especially for an introductory 30-minute call. So that's a really tricky one, because I'm very passionate about what I'm doing, and I'm just interested to hear your perspective on that, the difference between focusing on the storytelling side of my personal story and my journey versus the company that I'm ultimately building.
I would say in a 30-minute call, you should have enough time to do both. I think what we've been kind of saying over and over again is like distill what you're doing down to one sentence, and be able to tell that in a compelling way. Your resume should, you're not as old as John, so so your resume is not as cool. Probably.
His is the shortest resume I've seen.
Yeah.
All the time at Goldman Sachs and then FFVC.
And then FFBC, exactly. So your story, I'm sure, is very compelling, but you should be able to tell it in a short period of time, and enough to, like, in a 30-minute call, you're just trying to get somebody hooked. You're like, this is why I'm the right person to build this. This is what I'm building, and that's basically it. If you can convert that into a next meeting, that's when you can spend a lot of time on all of the details. So I would say go for short and sweet. Try to get the point of why you across, but really focus on the idea.
Yeah, no, I think that's good. I just want to throw something in there. I personally prefer to screen first with a call and then have a meeting. And I'll tell you why. Because in that call, I'm just taking notes like a banshee. And I feel it's really difficult if someone's come into my office and I'm sitting talking to them, to have my head buried down taking notes. And if I don't take notes, it's one of, 500 companies I saw in the last 12 months. They get confused. So you have to take notes, and notes can then be shared with one person and another. So the call is a very efficient thing, and I actually take one whole day and just do back-to-back calls a week on the screening side. And I think doing it would be too much drain to do that as back-to-back half an hour, 45-minute meetings with people, because there's much more emotional connectivity in the meeting. But I definitely want to have the emotional connectivity, but I need to filter first.
I'll maybe throw in a very quick 30-second comment. Is what?
I know you only do meetings first.
I only do meetings. I don't do calls. Well, a seed stage, fair enough. Calls are great, but as you get to Series A, only meetings I don't do. Yeah, I walked out from some VC meetings for these reasons. But where I was going with that is the first slide for me always, why should somebody be listening to you? And it's about you. What have you done and why you're like credible to talk about what you're gonna talk. So that's one single slide. Then if you can do a quick snapshot, the most exciting points about your business, which are like you should be able to share in 15 seconds, that's like kind of your money shot. So now you've proven to people why they should be listening to you, and now why they should be listening about your business. And then there's like, okay, tell me how you got to those numbers, and clearly you're a credible person. So there could be a very thoughtful strategic structure put in that checks off everything.
I'm sorry, I want to come back to this thing about storytelling. Very important. One of the most important things about a meeting when you're telling your story is to listen. If you go through a meeting and you don't listen, you didn't learn anything. So listen, read the body language, and tune the story to the individual and what they're looking for. And if they don't want to run through the story, guess what? You don't do a run through, and it's more Q&A, and that might be more fun. You might learn more from that. So listening in these meetings is essential.
Very difficult to do when you're on the phone.
So I have to echo, this has been very interesting and helpful and confirmatory. But I'm someone who was raised in the States, although I'm Canadian by birth and I'm back here. And I've been told a number of times there's differences between Canadian investors and American investors. And I can summarize it, I think, by Northrop Frye saying, the difference between Americans and Canadians is that Americans like to make money, Canadians like to audit it. So
that's great. I'm going to start using that.
Because the fundraising process in Canada is like you're just tortured at your neck for every tiny thing. So I've been told many times Americans would love that when I'm talking. So from your experience, obviously, Nick, would you find that the similar kind of dynamic?
So I guess what I would say, first of all, there are a lot of great upcoming funds in Canada. Like I really love Matt Golden and what he's doing at Golden Ventures, Boris in Vancouver, Boris Wirtz with version 1, Karam that does later stages, Inovia. They're great upcoming funds. But with that said, and I think one of the big differences that I see between Canadian and US investors is I think US investors have more exposure. There are many more deals that come across their table, and they have better pattern recognition, and as well as a result, they can help you better. The second thing, I think, it's either you go big or go home, and I really love this mindset, and literally that's why we've spent like an hour and a half in our board meeting. It's like, how do we go really fucking big, and what we're doing wrong here? And partially, I feel like we're being a little bit conservative in our execution, and I really appreciate John and Kimmy pushing us. The third thing, the access to capital in US is completely different. Like the size of Kimmy's fund, you can probably add up all the funds in Toronto and that will be Kimmy's fund. So like, let's be honest. So the depth of the pocket is like one of the local VCs got pissed at me because I didn't show him the deal when we're doing Series A. And I was like, dude, let's be honest. My raise was a quarter of your fund. I don't think you would have done this. So like, it's a very different ballgame. With that said, there are some really exceptional experts in different fields here in Canada that could be unbelievable early stage investors, and more Canadian funds are understanding for them to win great deals, they have to start adopting this mindset and pay up in valuations, get exposure by spending a lot of time in the valley, et cetera, et cetera.
I'm actually going to call out on Isaac right now. Isaac, you're from Real Ventures. Do you have any comment on that?
Yeah, take your money from Canadian investors at the seed stage, and then bring it to the Americans for the Series A.
Okay. Next question.
Hi there. I straddle the worlds of fintech and media tech. Fintech, I think, is somewhat more understood, but I don't often enough hear media or ad tech, which is another space that is going through a lot of disruption. My question is very specific. It's kind of related to the thought that was mentioned that you can look at Canada as a test bed and then look at a bigger market like in America. US is the hub of media, New York and so forth, that's where the big destinations are. Have you come across companies, or are you open to companies that look at a very specific other part of the world, highly populated but less developed economies in the world, to experiment with some product where the ultimate destination may be a bigger market like a US? It's an intensely specific question.
Yeah. So I would say in general, sure. We tend not to do ad tech specifically, but the sort of macro theme in your question is, do we look at companies that focus on other parts of the world, with the interest of then coming back to the States? Absolutely. Like Wish customer base is not in the US, right? Their like major customer base is outside of the US. But it's obviously a very fast growing, very, very exciting company. So we definitely look at spaces like that. That said, we may not have the expertise that you're excited about to be able to do that. Like there's markets that I don't have any experience in and don't know anything about. So I might be an expert in direct-to-consumer marketing, but if the consumers are totally different, none of that might be applicable. And so I would say in general, yes, but then the specifics would matter, probably.
We're predominantly US investors. We cheat into Canada and Israel, and we've got a couple others, 51st and 52nd state of America. I'm sorry about that. I was in Honolulu at some point. These things get stuck. The world is flat. There's opportunity everywhere. I had someone in my office like 6 months ago who was the head of the Angel Association in Alexandria. Not Georgia, Alexandria, Egypt. I'm like, there's angel investors in Egypt? Like, there's startups everywhere. Huge opportunity. There'll be a lot of local ones. There'll be international ones. There will be a Greek unicorn at some point. As we know, there used to be them about 2,000 years ago. A little bit of satire. They also existed about 3,000 years ago. So, there's opportunity everywhere. We're predominantly focused on the US. We're looking at a European drone company that we think will get to the US eventually. But there's some particular advantages of how they can leverage the legislation in Europe at the moment that makes it intriguing to us. But for us, it's that. Now, there are other seed firms who want to focus in those markets. Go there. But have a path, and Nikolai built a really good path into the US for capital because that's where the deep pockets are.
Cool. I think I'm going to wrap up questions now. I think we could go to like midnight with questions because we have 3 engaging panelists, but we have to be out of here by 8:30, so I want to give some time for people to meet someone new. Maybe they'll be out in the crowd answering questions.
Can I do a 20-second survey?
Of course.
Consumer product survey. Just show of hands. Who's on Android? Who's on iOS? Okay, those on iOS. How many? Who has these AirPods? Okay, and who has an Apple Watch? Last question. Who buys their batteries from Amazon? Thanks.
Okay. So sorry. Hold on, John.
Are you going to cut a check to someone?
Yeah.
One more, just because I think it's so interesting. Did anybody buy a Facebook portal? No.
Does anyone know what a Facebook portal is?
Does anyone know what a Facebook portal is? No. Did you buy one, Cam? No.
How many Alexas?
Alexas?
Okay.
Yeah, I'll let you know.
Google Homes? Wow.
How many had them and unplugged them because of privacy?
You know, my 9-year-old daughter unplugged it for privacy. She came down one day. She took we have a Google Home and Alexa, and she pulled both of them out. I go, what are you doing? She goes, I don't want them listening to me. So she's, I think we might all be open to it, but it'll be interesting to see what the generation after us does. Can I get a round of applause for Nikolai, John, and Kimmy?